Should we get a deal? Where's the risk of the market, to the upside or the downside?
I think the risk of the market right now is actually to the upside. I think that this has been overhanging the market. You know, if we get a China deal, we have seen so much guidance out of so many segments of the market, not just tech, basically talking about the impacts that this can have on retail and more broadly. So I do think that there's upside here.
Greg, what's your viewpoint? I mean, it sounds like you're pretty cautious about the back half of the year, because once we get through any sort of a trade deal, there are no more catalysts here for the markets.
Yeah, absolutely. We've already had a very big rally at the start of this year from the lows that we saw on December 24th. Part of that has been driven by the more dovish tone from the Fed. Part of that was maybe a rebound from oversold conditions at the end of last year. But certainly, I think a big part of that is there is now much more optimism that we will see some kind of trade deal. So I think that even if that comes through, it seems unlikely that it's going to push the market materially higher, given the rally we've already had.
Gina, you know, we've been denied around 2,800 in mid-October. We got denied again in early November and then in early December. Why is it going to be different? I mean, it really is hinging entirely upon China resolution?
Well, let me temper that comment. The comment I make is there's short-term upside. I agree with Greg that the back half of this year has very little to recommend. We are on a downward slide in terms of earnings growth. We're on a downward slide in terms of economic growth. We're just simply at the back end of the, you know, sort of the peak of the market and the peak of earnings growth. So it's going to take a lot to move the market meaningfully higher. Could we get a little bounce? Perhaps. That I do think we can get, but I don't think that it's going to sustain us. So I want to make sure that that comes through.
Greg, how do you position if your viewpoint is that there will be a slowdown in the back half of the year, that stocks won't make gain much traction? What are the sectors you want to be in? And is gold telling us something? I mean, gold right now is at the highest level since April of last year. For a short time, you thought, oh, gold, it's moving. But at this point, it's really something to be watching.
Yeah, absolutely. I agree with that. I think we've seen this rally in gold at the same time that yields have come down to low levels in terms of US government yields, but the equity market has been rallying. So in many senses, it seems that the equity market is the odd one out that has had a more kind of pro-risk, pro-cyclical tilt to it. So I wouldn't necessarily look to position in terms of relative sectors, but I'd be more looking at themes for more defensive corporates. So those with more defensive balance sheets, potentially net cash, those who have more sustainable buybacks, and corporates where we think there's less margin pressure potentially going to come through this year. So I would try and be more defensive, but I wouldn't necessarily do that by sector rotation. I'd more maybe try and look for some defensive themes.
Gina, in terms of the flip side of global growth slowing, we're seeing that in China, and we're seeing central banks meet that with the expectation of stimulus. Could there be the silver lining of stimulus help stock markets go higher? We've seen that in China already year to date in a very strong way.
Yes, but I think you're kind of hit the nail on the head. It's a small way. And at this point, continued stimulus, we have stimulated thus far. And continued stimulus needs to be ever larger in order to continue to move the needle. That's always the issue with that. And it's one of the reasons why I'm not so optimistic that even if we could get some stimulus anywhere in the world, that it will actually make a difference. It takes a lot more to move the markets today than it did 5 years ago. So I think we're just simply on this slide, and there's not a lot we can do except to get defensive.
Hey, Greg, if we did see some signs that China stimulus was really starting to kick in, would you rather own U.S. or non-U.S.?
Well, I think the idea of owning EM rather than DM markets, so maybe China or EM against the US, is certainly something we've been talking to clients about. We have seen a lot of inflows into EM equities at the start of this year, so it's already a trade that's starting to move. So we think we'd have to be cognizant about the right ways to position for that trade. So we do think EM could outperform DM, particularly if we kind of maintain this dovish view from the Fed and we do get something on trade. But we think we have to be quite tactical and nimble in that trade. And we've been talking to people about using optionality as one way to try and position asymmetrically to play that theme.
That's the most crowded trade of the year so far, according to the most recent Bank of America Merrill Lynch survey of fund managers. Greg, to believe in EM, you have to believe that China will be okay in terms of its stock market, maybe even in terms of its growth. Are you a believer?
Yeah, absolutely. I think you need to believe that the stimulus in China will have a positive effect, and that trade is crowded, and we have seen inflows into EM. But you do have to look at it in terms of a longer-term, multi-year period of outperformance. So EM equities have already troughed relative to DM, and we have seen some outperformance, and that's one of the reasons why we would be cognizant about how we position for that trade, and we definitely have a preference for asymmetric trades using optionality as a way to position for EM versus DM outperformance.